Larry, we had a lot of information out of the stock market toward the end of the week. I mean, on the early week, it was going up. The latter part of the week, it really sold off quite a bit. How much of this is signal and how much of this is noise, to borrow from Nate Silver?
You know, David, Bob Rubin famously told everybody in the Clinton White House, markets go up, markets go down. I think it's a mistake always to make judgments about deep and profound things, even about the future of markets, from how they behave over a period of several days. So I'd be very surprised if the events of the last couple days are historically memorable. My son, who's in his mid-20s, sent me a note in the middle of the day yesterday saying, hell of a correction, Dad. And I wrote back, by the standards of your young life. And he had the good grace to write back, fair enough. So I don't know where markets are. I have come to think that the idea that many had early on, how can the markets be so strong in the midst of a COVID shock so big? I think that idea that treats the divergence as overwhelming evidence that markets are wrong is misguided. You would expect that when interest rates were reduced as much as they have, when the Fed is as freely providing liquidity, when action is shifting towards technology companies, you'd expect to see a variety of the things we've seen. Are they overdone? Are the movements overdone? What fraction of that has been corrected in the last couple days? Each investor will have to make their own judgment. But just as every time it starts to snow, it's not a blizzard, though it might be. Every time you have a significant market move, it's not the beginning of something profound. So I think people should be worried about whether we're going to carry on an honest election in the United States. They should be worried about whether we're going to have a competent effort, which in many ways we haven't so far, to contain COVID. They should be worried about whether we're going to find a way of making our economy function so it helps middle-class people and a large fraction of the population shares in any prosperity that's created. I think the fundamentals are the more important things to be worried about than this particular market fluctuation, which I think is unlikely to be long remembered.
Larry, there's a lot of talk this week as there was a sell-off led by big tech that this might look like 2000. But as you pointed out to me, it's very different in part because of what you just pointed out, which is the central bank liquidity being infused into the marketplace, as well as the fact that the big tech companies are making a lot of money, unlike some of those tech high flyers back in 2000.
Yeah, I don't think you were talking about pets.com. In 2000. You were talking about an era when people raised money before they had their first dollar of profits, before they had their first dollar of revenues, before they had their first coherent plan. I think when you're talking about the largest companies in the marketplace, which is what the tech companies now are, you're looking at something very different than what we were looking at in 2000. And if you look at price earnings ratios, they're not in the same kind of stratospheric place that the tech sector price earnings ratios were in the year 2000. Now, look, that doesn't mean there isn't going to be a substantial correction of some sort. No one can know that, and I certainly wouldn't want to claim that. But I think that those who have been saying it's all a big bubble and are declaring themselves vindicated right now are premature in their declarations of victory.
Larry, one of the things that the markets don't appear to be waiting for is a fiscal stimulus package, that so-called fourth round. Otherwise, they'd be waiting for Godot because it keeps going on another week this week without getting it. At the same time, we had a report of the CBO about the level of deficit, which is going to go over 100% of GDP for the first time since World War II. Do the Republicans up on Capitol Hill who are concerned about this have a point?
You know, David, what I learned from the CBO actually made me a little less concerned about a fiscal crisis and made me a little more focused on providing fiscal support for the economy than I was before. We all know that the United States ran a big deficit in 2020. We all know that the debt to GDP ratio, which was around 80% at the beginning of the year, is going to rise to around 100% because of that big deficit and because of the declining GDP. The thing I didn't have a bead on until the CBO report was what was the path going to be out for a decade. And what I learned from the CBO report is while the debt to GDP ratio is projected to go up slowly over the next 2 or 3 years, from 2023 to 2030, on current law and on current projections, the debt to GDP ratio isn't exploding. It isn't rising very rapidly at all. It's basically flat. And what that says to me is that we're in a relatively stable situation. Now, then you can ask the question, is it a dangerous situation? Well, I think the way you have to look at a debt is to look at the interest flows that it generates. And in fact, we're spending less on interest as a share of GDP than we have historically on average over the last decades. And if you do what economists would tend to say you should do, which is look at the real interest cost of the debt, that is the cost net of inflation, real interest rates are now negative, which makes it much, much easier to carry debt. So what I learned from the CBO is not the current deficit figures. They're in the papers every day. They're in the Treasury accounts. Right. What I look to the CBO for every 6 months is an update on the long-run debt path, and that was actually a relatively serene projection. So I feel better now than I did then.
But is that because of the Fed, Larry, to put it simply? Because if the real issue is the interest costs, right now we're approaching the zero bound in interest costs because of the Fed. Are we essentially financing that debt? Is this really a form of modern monetary theory?
I don't think that's quite the right way to think about it, David. I think that if most economists will tell you that, yes, the Fed can set the interest rate this year, or maybe the Fed can set the interest rate next year, but the interest rate on long-term debt, the so-called five-year interest rate, the interest rate that's baked into markets for borrowing that starts 5 years from now and continues for 5 years after that, that's not something that the Fed can immediately control, and it's remarkably low. I think it's fundamental factors about savings and investment that are determining the low level of interest rates, and the Fed is basically tracking that in its effort to keep the economy stable. And this is the secular stagnation idea that you and I have talked about on this show, or the low neutral interest rate that people in the Federal Reserve System have been talking about. I think they're fundamental factors that mean we're going to have lower interest rates and therefore can carry larger debts than we did historically.